started then. All right, so this is the weekend Tortoise report for the report review for January 10th, 2015. Market is bullish normal. Looking at the annual time frame and weekly RSI 14, we're at 54 out of 100. Right in the middle of neutral. We're also in the middle of neutral on a 10-day perspective using the 10-day NDX with a score of 53 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is at 4.99%, which is yellow bullish, which is 3% higher than the edge of sideways. The slope of the 50 is white bullish at 0.40. ADX has declined the trendiness to neutral with a rating of 23.7. The Risc Index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the threshold between risk on and risk off. The current reading is at 0.93, which favors risk off or less risky targets. We take that score of 0.93 and compare it to the last 5,000 trading days and find the standard deviation bands around the average. That gives us the risk Z, and the Z score right now is minus 0.87 and getting worse. So here you can see the 90-day histogram of that risk Z indicator, and it came back almost to zero and rolled over as getting worse. So that suggests there still may be some more volatility embedded in the market here at the start of the year. In blended month rebalancing, you can see our holdings, which are will be reevaluated on or about 1 February. ETF 13, it's, you can see the defensive nature of these with real estate, treasuries, and technology. In ETF 22, it's utilities, real estate, treasuries. And then in this block, you can see the holdings based on the close of business price on Friday. And it's also, again, real estate, treasuries, and technology. In ETF 2, the theoretical exposure is at 40%. The model portfolio itself will be at 50%. So this is a defensive posture with some limited focused exposure. Just a quick look at the ETF 13 and 32 portfolios. Again, you see about half of them are on buy signals, which means price is better than the 4-month moving average. About half of them, these are the globals, are on cash. And then in the ETF 32, you'll see the same thing. About half are on cash signals. And you can see right now that it's U.S. real estate, treasuries, and utilities are leading the way. And it's all the globals that are suffering here. ETF Max uses the same lens to look at about the 1,200 ETFs in the large ETF database. China biotechs, China financials, treasuries, real estate. China, more real estates are dominating the top of the stack here. So that trend is somewhat of a global. This is the S&P 500, looked at through the same lens, the 30-month and 6-month blend. And we include the sector spider, the XL series that these are members of. So Staples continues to dominate here. Monster Beverage, Whirlpool, CarMax, Southwest Airlines still benefiting from the decline in oil prices. This is the market health check. We'll look back 4 months and describe what's going on here. The vertical blue lines represent 10 days, 20 days, and 30 days worth of look back. The horizontal red lines are support levels that used to be resistance, and which, if they break, become price targets for downward moves. The horizontal purple line is the previous is the price target, which was the previous swing high after this last little bump. That's almost a head and shoulders formation forming here. The dark blue shaded area is the river. That's the 30-period Bollinger Band, plus or minus 1. Lighter blue shaded area is the Bollinger Band, plus or minus 2. That's the floodplain. This red ribbon in the middle is the 10-period Bollinger Band, plus or minus a half. Call that the dragon. Notice how wide it's gotten. That's a function of recent volatility. The blue channel is the 10-period regression line, and then the RAF regression channel are the two outside lines, which are formed by the maximum excursion during the look-back period. The black is the 30-period regression channel, lagged by a day. You can see that the 30-period is basically flat, along with the river being flat, with the dragon oscillating, and then the 10-period actually pointing down. Price is holding right at the Bollinger Band mean, at the middle of the 30-period regression channel, in the bottom of the dragon. Everything is inside the river, so this is a sideways, certainly quiet channel. You can see this sine wave looking thin black line is the time series of the slope of the 30-period regression line, and you see it's been choppy here. Every blue circle is has been a place where it either crossed the zero line, which is this dotted line, or at a major turning point. And you can see we've gone from some decisively trending markets to some sideways choppy markets where the answer is cloudy. Check back later. We went from overbought to just about oversold and got rejected up in here at this last support level at 207. And so if we get any kind of weakness out of here, for me, that's a short signal with the target down here at 199 and 197, and then the 200-day moving average piece. This rejecting the price at a lower high is not a favorable condition. On the other hand, we do have a swing low, a higher swing low, and a higher swing low if this support at 199 holds. And that's why I have that as the boundary between yellow zone, where I have no directional bias, and the red zone, where I will have a downward bias. If price violates 199, then I definitely want to be short. I think it would then go down and test the 200-day moving average, and then if it made a new low below 197, then we would have a series of lower highs and lower lows, and that would be bad. You can see that the jaws of percent price oscillator are open to the downside, and that ADX is declining, so there's less trend, and the bears are in charge with the minus DI above the plus DI. So this is an aging bull, and this may be it for it. Let's see what we get. Now it's in terms of the longer term holders, market makers and whatnot, the old hands, it's noise anywhere from 0 to 5% of sell-off. And so if we hung that from 209 or 210, 5% would be minus 11 or 199. So it's all noise down to 199. That's a 5% pullback. A 10% pullback would take it 21 bucks below, or 189. So it would have to get all the way down here to 189 for the longer-term market participants to describe this as a correction in a bull. So 0 to 5 is noise, 5 to 10 is a correction. Anything beyond 10, that start talking about some bullish market conditions. So we have a number of targets on the downside. On the other hand, if we can get price above 209, then life would be good. It would be free and clear above, and we would notice this set of higher lows. So that's why I have us in the yellow zone here. I can make an equally strong argument for an expansive range move in both directions, and I'm really more concerned about the downside move right here. What with the globals and Europe still suffering, energy still having the world in turmoil, some geopolitical concerns with the Islamo-terrorists, and only the U.S. being a store of value. So in the meantime, it wouldn't surprise me to continue to see large cap defensive plays in the U.S. to continue to be the few safe havens in the equity world. So that's why I think we're seeing treasuries, real estate, healthcare, utilities being the preferred markets right now. So I think that continues. This is the ETF2 regional report. 6 of the 10 regions of the world are on cash signals, so that puts us at 40% invested, 60% cash. The S&P at 62 is stronger than EFA at 52, so it's still the U.S. in ascendancy. And then inside the U.S., it's technology at 64, small caps 64, mid caps 63, and the large caps 62. The 2 strongest sectors in the world are U.S. tech and U.S. small caps, and the 2 weakest sectors remain Latin America and Europe, IEV. Inside the sector spiders, we're back down to just 2 of the large cap sectors being extremely favorable, and that is utilities and healthcare. XLV is still your long-term friend. And then everything else is above average with the exception of energy, which is in the red. No surprise there. The world market model is next. All of the U.S. is above average. Small cap value is, small cap growth is exceptionally strong. In the alternate asset classes, treasuries and real estate are well above average. Asia, less Japan, and Japan are both below average. Malaysia and Vietnam getting smashed. Only the Philippines and India in the extreme positives. Latin America in the red, emerging markets below average. Everything Europe weak, especially Spain. And then the health and the business sectors in utilities and healthcare is reflected in strong positions overseas as well. And you can see that the U.S. is dominating or equal to all of the global counterparts. So it's still, the story is broad-based U.S. strength in large caps. I want to shift to the daily report. So we have no signals in the overreaction and channeling. You can see how the volatility has rolled over and come back into normal, but still, I mean, it's just barely into normal. It's coming off a period of exceptional volatility and is not declining in straight line back to quiet, but it's just kind of chunking around still, so that's a bit of a concern. Overreaction signals for financials and JP Morgan, triple screens for 3M and Visa, and then a half a dozen good candidates for the auto framer. These all test out better than 2 to 1 on the basis of a mechanical entry. Next up is the Dow 30 tactical summary. Nothing firing on the RSI-2. We have 2 exceptional fraud candidates here in Microsoft and Intel, which were both % winners on Friday. 3 test out favorably on the auto framer. That's Caterpillar, GE, and Procter Gamble. So we'll take a look at those 3. So let's see. Caterpillar, Pfizer, oh no, Procter & Gamble and GE. Okay. And a triple screen in 3M and Visa, so we'll look at those 2. And a overreaction signal in JP Morgan. Okay. And let's look at the ETFs real quick. Get some trading ideas. This is one just to notice. There's no signal for this at all. But when you look down here at Merck, It's been up almost 9% in 10 days. That's bucking the trend. And then it closed on the NDX, the 10-day, it scored a 119. And essentially what that means is this, that 119 reading says if we took a look at the last 10 days, I'll draw a little example here. If we looked at day minus 10 up to last Thursday as the 10 previous trading days, and we take the height of the, we find the lowest low to the highest high, then Merck closed at a value of 119, or 19%. Oh, that's a horrible 19, sorry. If we took, 19% is basically 1/5. So if we took the range of the last 10 trading days and took 1/5 of that, or 19%, and then stacked that on top of the trading range, that's how high the breakout was compared to the last 10 days. And then you see also that Walmart had a score of 121, so it was like 21% higher, or 21% of the last 10-day trading range. It closed that much higher than the trading range. So this gives you an idea of the magnitude of the breakout. And then Pfizer, with a score of 129, had almost a 30% breakout. So let's take a look at those. Let's see, Pfizer, Merck, and Walmart, just so we can see what those green signals mean when we see them on the daily report. Okay. All right, so let's shift and look at the ETFs. The ETFs, we'll notice here that IYR has that same phenomenon down here. It had a breakout on the 10-day, the 1 month, and the 3 month. So again, that was a 10% higher breakout than the last 10-day trading range. So essentially, if that was trading from 90 to 100, and that's a $10 range, so 10% of that would be a $1. So that means it closed $1 higher than the previous 10-day high. So that's how we read that, to get a sense of the scale of the breakout just by looking at this spreadsheet. Okay. Let's see. Just a quick look at the auto framer. We'll notice some of our old reliable friends in here. Caterpillar, USO. So oil is still has a 3.6 to 1 reward to risk ratio. Coal and energy, and commodities, which is DBC, is half of that is related to energy. So you can see that energy is still moving the markets. At the regression line fractal framework summary, these are the symbols in green, this top stack. These are the symbols that are the most ATR below their own regression line 270s. Again, so we take the regression line 270 to be the long-term fair value, and so Caterpillar is 9 ATRs below his 270 regression line. So we're going to take a look at Caterpillar as an RLFF value play. And then General Electric is 4 ATR. So if we think that price is going to revert to the long-term mean, and if we take the regression line 270 as the long-term fair value, then that allows us to frame a trade with respect to average true ranges on a daily basis. And now we can start thinking about how to frame a trade simply on the basis of trade location and the degree to which there is a difference of opinion between short-term trader estimate of fair value and the long-term trader estimate of fair value. When there's a significant difference between those two points of view, that tension that's generated has to get resolved one way or the other. And it may be just out in the future where we take the average as the price target, or It could be that the short timers run out of money and it quickly reverts back to the long. So in this case, we're talking about moves that are potentially anywhere from 4 to 9 ATRs. Now, these in the red are the ones that are the most above their own regression line 270. So these are the ones that are actually the relative strength winners. So Walmart, Visa, Pfizer, Home Depot, and United Health. No surprise there, 3 out of the 5 are in the healthcare industry. So that's how we read this, looking for trade frames one day at a time, try to take advantage of both relative strength and short-term opportunities. All right, that's everything I want to look on the daily report. Let's look at some charts of interest now. Okay, so let's try Caterpillar. I'm going to start with daily charts. All right, so here's Caterpillar on a daily. And I just want to remember why we were interested in Caterpillar. All right, so Caterpillar was an auto framer that's 3.3 to 1. And so you can see why we're interested here. Let's draw a quick trade frame. There's the day we're interested. There's our swing low. This line would be our entry. Looking at the 10-day high up here around 95. If we used yesterday's low, then our risk is this level, the range risk. And this would give us 3.3 of those on a simple retest of the 10-day high, which is essentially a reversion to the mean trade. If that actually works, then what you'd see is you would have this excursion down here to almost minus 2Z, and then a higher swing low, and then a takeoff that moves to here. And if it gets to 93, then our price targets would be 98, and then back to the long-term fair value, which is the 270 regression line up here around 102. Now, the thing to be concerned with is that we got price decay here. You can see in this area, Caterpillar was basically flat to fair value, and after a divergence on the downside, price came all the way back up to link up with the RL10 and the RL270 were both at fair value here, and then what you get is this excursion down to this price level. So now what we're talking about is here's one impulse up and possibly a second one. Does it get back to this decaying price line, or does it roll over here? And so this is a case where if we saw market weakness, then we would take, so in other words, if it breaks yesterday's low before it takes out the high, this is one that you can go short on because we're already outside the river. We have price failed to get back to the Bollinger Band mean here. The dragon has rolled over, everything pointing to down, so you could get short inside this space, and then you want to have your second position on somewhere around 84.60. Or if you just waited for a violation of that price, then what we'd have is price moving parallel to that downward sloping RL270. So Caterpillar offers trade opportunities in both directions. I would want to take it if it was moving in the same direction intraday as the market. So if the market was up and then Caterpillar was up better than the market, that's one where I would trade it one day at a time, as a swing trade one day at a time, until it had gotten above this Bollinger Band mean and this price at 94.80. So in this space, still very tactical, and I'm ready to go either short or long. Okay. Let's take a look at Procter & Gamble real quick. Procter & Gamble also sets up a nice auto framer trade here. What's nice about this is you have a swing low, a higher swing low, a higher swing low, holding support all along the edge of the river. And so if price holds here at 90, then what we're looking at is a return to 92, and then up to the 10-day high here at 94. And again, failure below 89 is a move back to the 270 regression line. And so if we see market weakness and then failure in PG, that one is shortable also. General Electric was also on the auto framer. This is even better. This is one where if it holds at 24, we can see that getting to 24.5 to the Bollinger Band mean at 25.40. Fair value at 25.60. The far side of the river at 26.10, and the far side of the floodplain, which links up with the 30-day high here. However, the nice move is this one, that if it fails below 24, look out below. So I'm going to scroll back and see what we can see about the next previous swing low. Yeah, this is one where failure at this price level is looking very gloomy for GE. So failure below, certainly below 23.80 is a triple bottom failure. But again, these are the kinds of support levels here. GE is such a strong component in the U.S. that finding support at this price level. Let me highlight this a little bit. It can find support in here, and now we're at a Z trade to Z minus 3. You get this kind of move. You've had this kind of move, and so from here, just getting back to the Bollinger Band mean at 25.30 is not out of the realm of the possible. So it's done that the last 3 times that it's hit that price level, and this RL270 is saying that the fair value for GE is 25.60. So there's a very low risk trade available in General Electric, and if we saw the plunge protection team jumping in to start buying U.S. Conservative large caps, then GE would certainly be a prime candidate here. It's certainly on sale right now. I really like that chart. Let's take a look at 2 triple screens, 3M. .3M's in really good shape here. It's one of the strength leaders in the Dow, and you can see that we've got a series of higher lows. We've got this. We have this 90-degree or 90. This RL90 is pointing up. The RL270 is pointing up. The Bollinger Band mean is pointing up. The Dragon is still at the Bollinger Band mean, and so this offers a nice opportunity here, as long as it holds support above the edge of the river. So you can buy this one. If we get market strength and outperformance in 3M, that's a nice triple screen setup. Let's take a look at Visa. Symbol, the ticker is V. Visa offers a nice triple screen pullback. Remember, when we get this pattern, what we're looking for is the outperformance on the long term, a measured pullback, and then the beginning of a price reversion to the mean. That's what this little resumption of the long-term trend. The long-term trend looks like the RL90 here. That's that green line. You can see that's up. The Bollinger Band mean and the river is flowing upwards. So we're in pretty good shape with that one. Let's see where and we're still, this is a strength leader. You can see that it's well advanced above its own RL270 here in this pink purplish line. That's the RL270, and that's after this little burst up, you can see that the slope of the 270 changed, and it's been nothing but up, up, and away since then. Yeah, really, it's got to get above 270, but there's time to get it from 260 to 270, and then on above 270, a second price upward. And then on the downside, I would say failure below 256 here gives you a tradable move back to the 270, which is at $240 a share. So you have a bidirectional trade frame possible in Visa. All right, let's take a look at the three symbols that had their breakouts. That's Pfizer, Merck, and Walmart. So PFE is Pfizer. Perfect example. So if we took the last 10-day trading range, you can see that we had a nice breakout here. I would discount this little spike up here. So the fact that it's above 32.25 for 2 days and held it over the weekend, to me, is free and clear. If we get any kind of strength in Pfizer, that's one that we can jump on, especially if the market is moving up. So if the market is moving up, then Merck is certainly one, or Pfizer is one we want to jump on. Let's take a look at his partner in crime in Merck. Almost the same pattern. You can see how these candidates in their sectors are moving together. And really nice move here in Merck. In the last 4 or 5 days, this breakout from a support base down here at the bottom of the river has now crossed over. The RL270 is up, up, and away. Now, one of the ways that I like to frame this is to find out what the previous excursion to the downside was. So from the 270, it was this move. It was from 61 down to 56. It was a $5 move. And then this one also from the RL10 back to the 270. Now I would say that it can go $5 higher, so that would put it up here above 65. So to me, the next price target is you take the size of this excursion and add it to the 270, and now up around 65 is where I would put that price target. Just to give you some sense of why we're interested in this regression line fractal, look at this last maximum excursion from the RL10 to the RL270, and once the Z pattern reverses, then it makes like a beeline to get back to fair value. So this excursion gets resolved by coming back up in here in a matter of about 20 days, and that's a move on the Z trade from 53 up to 62, so $9, about an 18% move. That's why we pay attention to this divergence between the slow and the fast regression lines. Let's take a look. I think we already looked at Merck. Yeah, let's take for the last one, we'll look at Walmart. Now this is one where you could say maybe it's a little more vulnerable. You can see the difference between the 270 and the 10, and we've got this double top here. It's almost like the horns of the dragon. So failure here could come back to the Bollinger Band mean. If it violates out of the river, it could come back to fair value down here around what is it, 81. I mean, I like the strength in Walmart. I like the fact that we've got we had a nice support level here, a nice support level here, and we had this breakout from the previous swing high. Excuse me. So I would like to see Walmart continue. If it were outperforming the S&P, so if the S&P were up and Walmart were up better, then I think that's when you can pile on, no-brainer. That's the classic buying a strong symbol in the strongest sector in the strongest country while it's going up. But that's how we would manage the risk on this one. Now, as a way to estimate the upside potential of this thing, let's take a look at the last maximum excursion from the 270, which was here. So when the 270 was at 77, it managed to get up to 86, so $9 above. So right now the RL270 is at 81. If you add $9 to that, that allows it to get up to 90 as a fair excursion. So we may already have seen the value add here. So my sense is I definitely want to see this one break above this previous all-time high at 90.50, and then I'm going to trade that one day at a time, and only when the market is moving in that direction as well. That's one that may already be stale. Okay. The last one I want to look at is no, not the last one. Let's take a look at Cliff, just because we always do. See how Cliff is doing. This is actually a pretty good trade frame right here. We talked about this one last week. We ended up buying this one at 6 1/4 with the stop down here at 6, and we had a couple good days inside here. I'm still looking at this price level as my price target. I like this one a lot still. And as long as support holds above 5.75, I feel okay about that one. Okay, now we'll take a look at our final one is IYR. That's that real estate. Just nothing. There's just nothing wrong with this chart pattern at all. Notice how we got a nice. We're getting nice support on the dailies from this RL270. Still marching straight up. Everything, that channel, all signs pointing to yes. You can reinforce that trade whenever it's outperforming the S&P. I think that's a really nice place to be. Okay, that's everything I wanted to cover for tonight. I will get this processed and hung on YouTube for replay if you're interested. I'm also going to finish up the markup, the write-up for the brochure for the June workshop. I've been negligent in getting that published, but I think again this is one that I think it's going to be by far our best one ever. I have big plans for it, and I'm excited about the learning opportunity that represents. So, pending your questions, that's everything that I wanted to cover tonight. So, this is Ken from Tortoise Capital. Keep your risk measured and your powder dry.